So let's start with Ron. Ron, welcome to the show.
Thanks, Michael.
All right, I'm glad you're here. Give the audience some background on you. I know that you're in San Clemente, a long time a family favorite of mine. It goes back to, well, I guess 1769. But I want to hear about you and your company, and then let's talk about these 10 shocking truths.
Sure. Well, career-wise, I started, my first job was with Northrop, designing jamming equipment to jam heat-seeking missiles. So I have a master's in applied mathematics. And then I sort of changed careers and went on and got an M.B.A. in finance from the University of Chicago, and was a pension consultant for many years. And when target date funds got on the horizon in 2006, friends called me and said, I need to get on that. So I've been involved with target date funds for a decade now. And I know that's what you want to talk about today. And I maybe take a minute to tell your listeners what a target date fund is. Would that
Yes,
make sense?
Absolutely. I was going to go there. Yeah.
Right. So the idea of a target date fund has been around for a long time, and it was originally used for college savings plans. And what it does is when the event date is distant, so you're not going to go to college for another 15 years or whatever, the fund is fairly risky. And then as that date gets close, it gets more and more conservative, and the notion is as you get close to the day when you're going to really need the money, you want to protect it, you want to keep it safe. And that idea has transitioned over to 401k plans and has become the most popular default option. And I'll just explain what a default option is. So 401k plans were sort of not getting the kind of enrollment that everybody hoped that they would. So participants weren't signing on to participate in the 401k plan. And behavioral scientists suggested that instead of offering it as an option, when someone starts to work for a company, make it automatic. And then the option would be for them to opt out. And lo and behold, the behavioral scientists were right, and people did not opt out. So more and more participants were in the 401k plan. And that was great, but it created a new problem, and that is many people who were in the plan had no idea about how to invest their money. So the plan sponsors needed to do something with that money. And so the participants who, quote, defaulted, couldn't decide, the sponsor would generally put them in very safe investments, cash, stable value, whatever. And I think that was just fine for older participants, but probably not for the younger. But then in 2006, the Pension Protection Act identified certain safe harbors as default alternatives, and cash is not in there. So it identified target date funds, what's called a balanced account, and then also a managed account where you would have an advisor help you decide on how to invest your 401k assets. By far, the target date fund option has become the most popular default. It's grown from almost nothing in 2006 to $2 trillion today. And in terms of the 10 shocking truths about target date funds, they all really tie into what fiduciaries have been doing. And they have generally acted more to protect themselves than to protect their beneficiaries. And by that I mean the choices that fiduciaries are making in selecting their target date funds are, number one, there seems to be this belief that any qualified default investment alternative under the Pension Protection Act of 2006 will work. So there's sort of this belief that you just throw darts at the qualified default investment alternative dartboard and you'll be protected. And that's just not true. Second, I'm sorry. Go ahead, Michael.
I was going to say that when you're going down this road, you're also making a statement that the next market correction could bring lawsuits, right?
Yes, and I think it will. And the reason is I think fiduciaries are not. They're breaching their duty of care, and the duty of care really says that they should be looking for the best target date fund for their beneficiaries, and that is just not happening.
Really?
And to do that, what they really need to do is to develop objectives for the target date fund. And what they've really signed on for by just this dartboard thought is to settle for what's being sold. And the objectives that are being sold are hopes. They're not objectives. So target date fund companies running $2 trillion have come to the plan sponsors and they've said, so we've designed these things to replace pay and to manage longevity risk. And anyone who looks at that in any realistic terms has to realize that those objectives can only be achieved if you save enough. So what they're marketing, in essence, is somehow making up in the capital markets for inadequate savings. And that's the hope. That's not an objective. And further to that, I'll say that the second belief on the part of plan fiduciaries, first of all, any QDIA will do. But second, the three largest bundled service providers in the country have got 75% of the target date market. So Vanguard, Fidelity, and T. Rowe basically own the target date fund market. And that's going on not because they have the best target date funds, but because they're the bundled service provider.
Are they coming to market with innovation these days, or is that kind of stymied because of the monopoly?
It's stymied because of the monopoly. So that is on the list of 10 problematic areas in the area of target date funds. So why would the fiduciaries get sued? In 2008, the 2010 target date funds, so for people who are going to retire 5 years either side of 2010, so some people had already retired and some were going to retire, those funds lost 30%. And there was a public outcry. In June of 2009, the SEC and DOL had their first ever joint meetings to figure out what they could do to make that never happen again. So there's all sorts of proclamations that there are going to be more disclosures, that this and that were going to happen, but nothing happened. But what did happen is in the 10 years since 2008, target date funds have gotten riskier. And that's because there's been this performance horse race. And I will tell you that the target date funds who get the highest Morningstar ratings are the riskiest. Mm-hmm. So if you were a plan fiduciary and using Morningstar ratings or using your bundled service provider, you are taking a lot of risk, and the average equity exposure for target date funds at the target date now is 55% in equities. And that's up from what it was in 2008. Second, bonds were the savior in 2008, but now with interest rates being what they are, in the next market correction, there's a pretty good chance that we're going to see the bonds get trashed as well.
Wow. Ron, let's drill down on these on the next time you're on the show. I'm glad you opened up the topics of conversation that we can reach out to. Please, before we go, real quick, contact information for you.
Sure. I'm Ron, R-O-N, at PPCA-INC.com.
Great. Ron, thanks for being a guest. I'll be talking to you real soon.
Thanks, Michael. Bye now.
You're welcome. All right. Ron Surz, President, PPCA Inc., PPCA-INC.com. You've been listening to CEO Money with Michael Yorba. We'll be right back on the other side of this break with Jason Riley.